Oh man, so we're live for the FOMC meeting. Are we going to get that 75 basis point interest rate hike? Are we going to get more? Are we going to get less? What impact will this have on the cryptocurrency market? We've just got off a course member live stream where we were preparing for the various different outcomes with our course members. You guys are always open to joining those ijaz.uk/member if you want to jump into our course member live stream. So big meeting today, a lot to look out for. Let's take a look at the wider market and see what is going on. Let's take a quick look at the Bitcoin price as well, because we're sitting pretty precariously near this 20,000 mark, right? And we know this is a really key level for us here on Bitcoin. We've managed to get a bounce just before 20 here. It looks like we're getting a little bit of a curling up. This is very normal to expect this kind of volatility leading up to the FOMC decision. We've got 8 minutes to go before the interest rate is announced. Apparently this is still unlisted, so let's get that listed. Why that's happening? Some of you are saying you can't see this, so live. Oh. Still got 8 minutes, plenty of time before the interest rate announcement. Let me know what questions you guys have leading up to this announcement, and we'll cover those off. Put them in the chat. I'll be able to cover those off for you guys. But it's critical. The key thing we need to watch out for is, I think, we could actually disappoint the market with a lower interest rate hike. And that's the interesting thing here. Is normally if you get a lower rate hike, the markets tend to rally. But I think it's got to the point where the market's just going to say, forget that. You either move to the upside or we're going to fall. So that's what's going to be interesting, is are we going to get that? Is that what's going to be what happens? That's going to be the key. Let me know if you have any issues seeing this, guys. I know my computer is struggling right now. Interesting. It's okay. I have like 2 tabs open. So this is still available for you guys to see. Don't forget, guys, it's not just the interest rate hike today. We're also going to get the summary of economic projections. We're going to go through that as well. There's a lot to go through today. Make sure you stay tuned. And don't forget, there's the press conference as well. So 6 minutes, we'll get the announcement of the interest rate hike. We'll see how that affects the market. Then after that, we're going to have to look at, what impact does this have during the press conference when Jerome Powell actually speaks. Okay, so that's going to be important. Okay, now that this silly computer is struggling, hopefully we're live now.
The gateway to the public markets, and to be part of that, it's truly amazing.
Dad, are we really gonna miss the game?
I think we're stuck here.
Hey, you guys doing okay?
Dad, it's John Elway!
Our planes haven't.
Okay, good, that's working. So we know that is set for when we need it. Still got another 5 minutes to go. So guys, let me know if you have any questions. We've got 5 minutes before the interest rate hike. So let me know if you have any questions. Key thing here is, are we going to get that 75 basis points? I'm calling this a Goldilocks. I'm going to call this the Goldilocks FOMC meeting. That's what it is. It's a Goldilocks FOMC meeting. Let's just make sure we're tweeted out so everybody knows we are live. You guys can tweet as well. Always helps. I think so. Yeah, somebody's asking, what do I think? Is it going to dump? I think the bias of this meeting is downside. Like something really incredible would need to happen for us to rally, and I can't. I don't know what that's going to be. I think we can get a sideways / minor rally if it's 75 basis points, but you know, if it's 1 whole percentage, I think the market's going to fall, and I think if it's only 50 basis points, the market's going to fall as well. So it's like Jerome Powell's kind of damned if he does and damned if he doesn't. Okay, good. So put it out in our Discord so everybody. And guys, get comfortable. Go get yourselves a drink. Do what you need to do. This one's going to be quite a while. This one, because like I said, you've got the interest rate announcement in 3 minutes time, and then after that we have the press conference. There's 30 minutes, and then the press conference. We're going to do it all in one live stream. We're going to see how the market reacts. We'll get the charts up. We'll get the news up so we can cover that off as well. I'll see if I can pull up the PDF back together. Stay tuned. Let me know if we have any issues throughout the stream, guys. If a couple of you can just, like, maybe Ian, if you could drop me a message if there's any issues with the live stream, that would be super useful. In terms of audio or video, just let me know. Good, awesome. We've got 36, 45 of you guys. Do smash up the like button, guys. 45 of you in here, only 9 likes. Smash up the like button. Let's get this stream shared so more people can actually start to understand the impacts of FOMC meetings, interest rate, macroeconomy, and how it affects crypto, right? Because it's not just about, oh, look, here's a chart pattern and, you know, this is why we move. No, there's a real science behind it. We need to understand what is going on. That's really, really important. So do smash up the like button. Spencer, good to see you here on a live stream. Finally made it. Yes, you did, sir. Ross Chapman, good to see you again. JJ, Omar, Present Trend Production, MK, good to see you again. So good to see a lot of you familiar faces in here. Mubashir, what should ideally happen for crypto to pump? Most underrated crypto YouTuber, Judo. Very kind. Appreciate you guys. Right, 1 minute to go. 1 minute to go. I'm going to keep refreshing here to see what do we get. We'll have the news playing. So let's do that. Let's have the news because they'll announce it. Sometimes they have like a watershed. Let's get them back
and
on.
Yes, we are down 20%, but what we'd say is the good news is the market seems to have discounted a lot of economic pessimism here. If we do look forward, we think we're later stage in this economic cycle, but if we do get a downturn, we don't expect it to be a prolonged or deep one by any means. And so the upside down.
I'm refreshing as we speak, guys.
From these levels should give you a little bit of comfort. So yes, painful time,
Sometimes
but keep in mind you've had a good run, and perhaps you're starting to think about coming out the other side here.
All right, well, that's helpful. That's positive, Mona, and let us put you on the record that 3/4 of a point is where you are. John Bellows, where do you see the Fed going?
Yeah, we think the Fed's going to hike 3/4 of a point today, perhaps guide towards a similar size hike in July, although I'm not sure that matters right now. Their credibility is really in question. I think the bigger kind of issue for investors is the risks around policy after that, so September and beyond. We've been in an environment where it's been a string of hawkish surprises. I do think, however, that going forward, the risks are more balanced. You know, growth is decelerating. As Mona just mentioned, yields are quite high right now. And should we get a moderation in inflation, which I think is building in the data, you know, we're going to see much more balanced risks, and we could see a less hawkish Fed by the end of the year. So hawkish today, guide hawkish, but less hawkish into the year.
We've got 1 minute, David. What do you think? I want to hear you talk about the Fed's credibility and its reputation. Everybody says they were behind the curve. They got it wrong. How do they restore their credibility and reputation?
Well, I think they have to be adult about this. I know, you know, I also expect that they're going to go 75 basis points. I think that's a mistake because if you look at the summary of economic projections they're going to put out in a few minutes, I think they're going to show economic growth slowing towards the end of this year and next year. I think they're going to show inflation coming down anyway. We've got massive fiscal drag. We've got a dollar that's up 10% since the start of the year, hurting exports. We've got mortgage rates up 2.5% since the start of the year, hurting housing. This economy is going to slow. Inflation is going to come down anyway. And to restore their credibility, they've got to be able to push back at people who say, oh, you've got to hike to deal with inflation now, because they've got to take a long-term view. And a long-term view, inflation is going to come down anyway.
Yep,
the goal here is to avoid pushing us into.
Confirm 75 basis points on the PDF. Let's see if I can switch guys over to the iPad. Oh, they're going back onto it on the news. Let's
Committee raising the funds rate by 75 basis points to a new target range of 1.5 to 1.75%. First time they've done a 75 basis point rate increase since 1994. It plans to continue its plans to reduce the balance sheet as laid out in the prior month and anticipates additional increases in the funds rate. To wit, the new forecasts from the Federal Market Committee show that they see the rate outlook for 2022 at 3.4%. That's up from 1.9. Pretty much meets where the market is. For 2023, it's boosted its own rate outlook, the median official, to 3.8% from 2.8%. That's a full percentage point increase. And again, pretty much meets where the market was at, maybe the market where the Fed was at. We don't know which way this works, but it is one of the most dramatic increases in the outlook, the near-term outlook for sure, of the funds rate that we have since we've been publishing this since 2011. The Fed repeating that inflation remains elevated. It sees the Ukraine war putting upward pressure on inflation. Says the China COVID situation, the lockdowns there are worsening supply chain problems. Economic activity, it points out, picked up in the second quarter from weakness in the first, obviously. It cut, however, its 2022 and 2023 growth forecast pretty sharply for 2022 by 1.1 percentage points, boosting the unemployment rate a bit for this year, 3.7%. But when you go out, they've raised it by 0.5 point in 2024, boosted its core inflation outlook just a bit to 4.3% for this year, but otherwise sees core inflation declining to around its target of 2.3% in 2024. Finally, this was unanimous except for the fact that Esther George, the Kansas City Fed president, dissented, wanting a 50 basis point increase, which is interesting in and of itself. But there you go, guys, a 75 basis point rate increase, and the Fed saying it anticipates additional increases in the funds rate will be appropriate. Back to you.
Steve, stick around. The market pretty much taking this in stride, with stocks roughly at levels that they were before the decision hit. Same can be said of interest rates at this very early hour. Let's bring our panel back.
Okay, so as you can see, guys, straight after the announcement, this is the minute chart, okay? So they're moving very quickly, a big move to the upside and then back down. Remember, this was the best case scenario, 75 basis points. So that's good news. I think at 50, we would have fell. At 1%, we would have fell. So now we're going to find out what is this, and hopefully it could be sideways / slightly up. We can't lose 20K on Bitcoin. That's the key right now, right? That's a high from the previous bull run. You can see here, Bitcoin just waiting for the S&P to decide on direction before deciding on its move. So 75 basis points as expected. And Jerome Powell is basically saying to markets, look, I'm willing to do what it takes. And clearly he made a mistake, because the previous meeting he said 0.5 basis points. Oh, as I'm speaking, you can see the S&P taking a move to the downside. No doubt Bitcoin will follow it. You can see Bitcoin on the left-hand side following it now down to the downside. Again, can it hold above 20K is going to be the key thing. If it can hold beyond 20K now, that'll be good news. And then we'll go see what Jerome Powell says in the press conference within the next 20 to 25 minutes. So that's going to be the key. Will he say anything? Will he come out super aggressive? Those are the things we need to hear. But I think it got to the point where Jerome Powell wasn't being aggressive enough, and it took the market to tell him, hey, do more, which is very, very unusual. Markets do not want interest rate hikes. They want accommodative policies, but inflation was getting so silly that the market said, we'll price it in for you. We priced in 75 basis point. Now, can you do 75 basis point? Jerome Powell had to do it, even though at the last meeting, he said he would not do 75 basis points. So that's where we're at. We'll continue to monitor the charts here to see what's happening. A bit of a green candlestick here on the minute on the S&P. The market's just going to do some volatility. Naturally, you're going to have scalp traders trading the volatility. If you guys want to trade, and if you're an experienced trader, you can do so using the links in the description to BYBIT and PRIMEXBT, who are giving $4,000 and $7,000 respectively. All you have to do is deposit, and you can access up to those bonuses if you're an experienced trader. For the rest of us who are dollar cost averaging, let us dollar cost averaging at peak price points. I've been doing some nibbling on Bitcoin and Ethereum over the last kind of 24 or so hours. And again, if we get lower price points below 20K, I will be doing some more purchasing. I've got some limit orders set up, and I'm happy to accumulate my positions. I'm not playing around with many small caps, but the big caps, more than happy to pick some up. You've got the S&P continuing to show red candlesticks here. You've got Bitcoin, which will naturally follow alongside. Let's head back over to CNBC to see if they can give us any more insights. Remember, we're going to go through the summary of economic projections as well shortly.
Prod to go 75 this time. Inflation expectations in the University of Michigan sentiment survey is basically gasoline prices. So they're going after this one thing that they may not be able to affect. I think it's okay. Look, financial conditions have tightened a lot. Jay Powell in the press conference could choose to emphasize that. And he might also be able to say, well, you talk about our credibility. We've only just been a lot of words in the last 6 months. And look at what's going on with mortgage rates, with high yield debt spreads and all the other things in stock valuations. We've kind of got a lot of this in the books already. Maybe we're sort of front loading it and you can see around the hill to when it's almost over.
And David Kelly, there are a couple hints of dovishness, if you want to call it that, in this decision. Interestingly enough, Esther George dissented in favor of a smaller increase. We tend to think of her as somewhat more on the hawkish side, but she only wanted a half-point hike. And the median Fed official sees the rate at 3.8% at the end of next year. And you could argue maybe the market had actually gone a little higher than that.
A little bit, but the markets moved very fast in the last few days, even as the Fed officials are putting in their forecast. So I think it was a given that the market was going to be a little higher than the Fed today. But I think it's really interesting that Esther George.
Okay, so summary of economic projections. Let's run through this to see if there's any interesting updates. Let's see if you can. Well, that would be useful for you guys, wouldn't it? Great stuff. So let's take a flick through. Okay, so change in real. Okay, so what you're looking at here is you can see the projections from March 2nd. There we go. There's our dot plot. So that's the dot plot. This is showing us where each of the Fed officials vote for interest rates to come in. Okay, so these are the projections they think for 2022. You can see the bottom, 2023 and 2024. So longer term, the majority see the federal funds rate between 3.25 and 3.5. Can you see that's where this center point is? That's where the majority are seeing it, which is just section here. So that's where the majority are seeing it. They see by early 2020, well, by 2023, the majority are expecting the rates to be above between 3.5 and 3.75. That's this section here. So remember, that's the middle section here, which I've just zoomed into. So that's the key here. That's what we want to understand, is what is the midpoint of the target range that they're expecting it to come in. So it looks like here the majority quickly expect us to get to between 3.25 and 3.75, and we'll probably stay there throughout 2024. That's what their expectations are from this dot plot. Let's continue down. Not that. Let's go back to start. And this is where they show us what they expect in terms of the change in GDP. So now they're saying GDP in 2022 will be 1.7%. 1.7 in 2023 and 1.9 in 2024. So this is significantly lowered from the previous higher number readings coming in. You can see the March projections below those numbers, just under there, showing significantly lower readings than previously. Okay, so that's an interesting thing to observe. Now let's see what they're saying back over at CNBC, see if they're giving us any interesting insights. If not, we'll
all of my colleagues here have highlighted, it really does come down to the inflation and inflation expectations. The Fed, I think, is reflecting what we did see this past Friday, where headline CPI came in well above expectations, and they moved that up to 5.2%. Interestingly, core inflation, of course, excluding food and energy, was lower, 6% in the CPI print, trending downwards, and I think that's reflected as well. I think they do think they can get 2.7% next year. Keep in mind, the Fed actions really do impact core, and two trends we've been seeing. One that John just highlighted, cooling housing market, but the other one is a potentially cooling labor market. We've already started to hear technology companies having layoffs. Over time, that will impact not only the unemployment rate, but the potential wage growth that we've been seeing. So as the Fed has been indicating, as we've been saying here, I think generally by the end of the year, we should see moderating inflation. And that will really be this cycle's Fed put. The Fed can then go at a more gradual pace. They won't back off until inflation starts to come back towards their 2% goal. But if they start moving at a more moderate pace, I think that's really when market sentiment can turn in a more meaningful way.
We've seen stocks give up most of their gains. Rick, we saw the Dow up 400 points earlier today. We were up about 100 going into the meeting. We briefly dipped negative. We're up 60 right now. NASDAQ still up 1%. This now, any comment on why we might be fluctuating more to the downside just in the last couple minutes here?
Yeah, I really do think as this sets in, we are.
Okay, so let's switch back on over to here. What we'll do, spend a little bit of time going through this. What I wanted to show you take this here. That they initially thought that the GDP in 2022 would be 2.8. That's been revised down now. That's been revised down quite heavily. 7. They thought we'd then have a slower 2023. Again, they're sticking to 1.7. And then 2024, they've dropped that down by 0.1% as well. Okay, the longer run has stayed the same. So in essence, you can see that we're preparing for a slowdown, right? 1.7% growth is not much at all in GDP, and you can see that there. You can also see that they've upped their unemployment rate. Okay, so gone from 3.5 to 3.7. They've upped the employment rate in 2023 again, 3.9. That's a big jump there, and upped it from 3.6 to 4.1. So unemployment is looking like it's going to stay, according to their views here. Then looking at core inflation, if you look at the PCE inflation, again they've notched that up by 0.9. They've notched this one slightly down. They notched this one slightly down, but 0.9 in 2022. I mean that's a huge adjustment to be making from just March to where we are now in June. That's a big tick, and same with core. And it just goes to show that these officials didn't know inflation was coming. They were so focused on the fact that it was transitory that they've mistaken it. So definitely, so far they've revised GDP down big time, revised unemployment higher. So they boost unemployment, and they've said core inflation outlook now going to set to 4.3% core inflation. Okay, so this is big, and now it's showing that look, it's basically saying that we were wrong. And now we have to change that. And the Fed funds rate, they've revised from a 1.9 to now a 3.4 projection by the end of 2022, which is pretty much what the market is pricing in to say, look, we need to get there quite quickly. And they're pricing 3.8 Fed funds rate for 2023. Okay, let's go take a look at what the markets are saying. Because we need to see what the markets are doing, because we need to look at the charts, don't we? And as you can see, S&P did fall a little bit. These are the minute charts, so forgive me for them being so erratic. I can't help that whatsoever. You can see it's trying to get a little bit of a bounce here. Interestingly, let's see how Bitcoin's getting on as well. Bitcoin getting silly close to 20,000 right now, guys. This is, what was the bottom there on that one? Just literally bounced at 20,200, getting really close. Let's pop on over to the 5-minute charts just to give us a little bit of a zooming out here, because sometimes in the minute charts you won't get the best picture of what's going on. There you go. So a couple of three red candles, followed by trying to create a little bit of a bounce now on the green candle. S&P doing similar thing. Bitcoin's just following the S&P as you'd expect. So nothing too surprise-worthy. Have any of you got any questions? We've got 15 minutes. Until the next press conference, when Jerome Powell comes out and answers Q&A, and this can be important. This is the bit that can move the markets as well. Bo Ibrahim says, "I'm going to McDonald's. Anybody need application? Yes, please. Email it to me, please." Robert Powell says it's all over. Bye. Code ready. Jasmine, brother, are we going to die? We're not going to die. It was a good meeting. It was the best meeting we could have hoped for. The issue is there's nothing in the market to make people excited, right? What is there, if you're being realistic? What is there to say, oh, we can moon off the back of it? If you guys, okay, like a lot of you guys weren't in the markets many years ago, fine. But even if you were in the markets last year, you will remember that there was a lot of positive things going on that would give us an excuse to run to the upside. By the way, guys, we've got 147 of you guys in this live stream, which is fantastic. But please do smash up that like button. I'm going to sit here in my evening, 7:15, not had any food yet, landed from Austin, Texas yesterday, but I'm going to sit and listen to Jerome Powell for you guys. So please smash up the like buttons. Can we at least get 100 likes? There's 142 of you in here that can help me do that for completely free. So, yeah, I don't think we're going to die on crypto, right? I mean, this is the point where if you guys are watching this type of content right now, kudos to you. Anybody who's entered the market this year, it's been a really tough time for you. But the fact that you're sitting here, the fact that you're learning, the fact that you're listening to how the macro economy can have an impact on your investments, you guys are going to be just fine. You just need to make sure you don't panic sell. Make sure you're pragmatic. Make sure you keep learning, keep investing. You're going to be in a good position, right? These are the bear markets when people fall out of love with crypto. And your job is to make sure you stay in love with crypto. That's the key right now. We need to stay in love with crypto and continue to educate ourselves on the thing.
Rate hikes. Before that, we have more analysis from former Fed Governor Randy Kroszner. Keep it right here on Power Lunch.
How about we don't keep Okay, so that we went through that. We've gone through the summary of economic projections. We've got the triple rate hike, which is what the market demanded. And now we just need to see how this plays out over the next few weeks, right? Jerome Powell's going to come out and talk 14 minutes, and then the markets can get back to work. Get back to work on deciding where we're going to go to. But for me, I was saying this to the course members earlier on, just before this FOMC decision, that we need to prepare ourselves for substantial downtime, right? We could be getting substantial downtime. If you remember, if you look at the previous bull run, you ran up to about 20,000, and then you had 12 months of decline till you got to the lows between 3,000 and 4,000. And then from there, you stayed like that without going and creating a new high for 18 to 24 months, right? So we've got to be prepared for that. We're not even 12 months into our decline from November 2021, where we ran up to 69,000 on Bitcoin. So if we follow that same pattern, and by the way, you can argue why this could be worse, because this was not pandemic-induced. We just fell based on a deeper global recession, right? This is not the same as the COVID fall, because the COVID fall was followed by unprecedented printing, which is why Bitcoin continued to roar. Right now, we have the opposite: liquidity being taken out, interest rates being increased, quantitative tightening being increased, right? So money's being hoovered out of the economy, and that makes things more difficult. And Bitcoin and crypto as a whole has to navigate this. Guys, thank you so much for smashing up the like button. We are just a few away from 100. 12 more of you guys who haven't hit up the like button, kindly hit it up. If you've already hit the like button, it's really important that you don't hit it again, because the number will go down. You can hit it an odd number of times, but you cannot hit it an even number of times. That would not be great. Pele Fuentes, have you got your... I don't understand what you're asking there. You guys are talking about degen plays, as I would probably have expected. Guys, please stay away from degen plays. Which sectors do you think regulation is going to hit the hardest? I mean, obviously the regulation is going to come after the stable coins. Anything who's doing stable coins and lending, you're going to get it, right? Regulation, and rightfully so, because those are the guys that are messing up the market right now. People making good use cases, governments won't get in the way. Like, if you look at normal business, look at traditional finance, right? When regulation comes in, it doesn't just go after people doing normal businesses. If you're selling like cupcakes in a shop, apart from health and safety and those kind of things, like, you're able to make cupcakes. But when people are doing dodgy things, when banks are selling derivatives and credit swaps and packaging up toxic assets and reselling them, then you need regulation. And that is exactly what the likes of, these kind of players are doing in the crypto space, and rightfully so. They should be liquidated. They should be regulated, sorry, because they're making it difficult for all of us. Ian, you crack on, mate. I know you've got work. Did the numbers come out? Yes, 75 basis point increase as expected, as the market demanded. And now we need to see what happens in the market. You can see here, we've got the charts up here on the 5-minute charts. S&P initially fell quite sharply, and then now just rebounding. For me, this is sideways action. These are no major moves here on any of these. And we'll just switch on over to the news. They've got a guest here. Let's see if this guest can give us some insight.
That just happened. And tell me what just happened.
So I think they got very focused on the increase in the expected inflation, those numbers that came out at the end of last week. I don't think they put that much emphasis on the inflation numbers that came out on Friday. One, it was the CPI, which they don't focus on as much as the other index that they use that comes with the GDP report, the PCE. But the thing that they're most worried about is inflation expectations becoming unanchored. So far, longer-term inflation expectations had been in the same range as they had been really over the last few years, maybe at the upper end of that range, but they broke out above that. I think that pushed them to 75, and I think that's the thing that they focus on most importantly.
Is this the Fed then being data dependent?
Well, it's not just the data. It's being forward-looking. It's looking at the where the expectations are going. So, as I said, I think it's not just about the inflation print from last week, which I don't think was that far out of line. I mean, a lot of people have focused on it as being so high. I think it was pretty much in line with the Fed forecasts. But the increase in inflation expectations, that wasn't what they were expecting, and I think that's what drove them to move more. And I think you're going to hear a very hawkish discussion at the press conference from Chairman Powell.
Let me ask perhaps
Interesting. So he's coming out and saying he thinks Howell's going to be pretty hawkish. I think so too. I think he has to. He hasn't got a choice. He comes out soft now, and the markets will not be happy at all. I mean, to put this into perspective, guys, just before I show you one more thing, I do want to show you this, which is the inflation rate, right? You can see we just climbed up all the way to 8.6%. This is not a joke right now. This is insane. He had a 0.25% increase, didn't have an effect. He did a 0.5 increase, it didn't have effect. Even though he rolled out a 75 basis point hike, he's had to now put back a 75 basis point hike. How can the market take someone seriously? Somebody who's been saying it's been transitory all of last year, who does his interest rate hikes, and it doesn't even move the market. It's absolute insane right now. And the market is almost telling him what to do when he's the chairman of the FOMC. So this is not great from Jerome Powell. And really, this needs to get sorted out. I mean, coming back on to the Fed rate monitor, these use the future CMEs to give you an indication of where markets see the future rate hike being, and obviously it gets less accurate as you go into the future. But just to give us an idea, by December 2022, you've got half of the market expecting a rate between 3.5 and 3.75, okay? And then if you add this bucket as well, 80% expected to be somewhere between 3.5 and 4, okay? Now let's remind ourselves why that is important. What I'm going to do, let's switch on over to here, and what you see is the dot plot, right? And this dot plot which was going through, and you can see that this is 2020 bottom. We're looking at 2022. Sorry for stepping away from the mic. And you can see here, where is the majority here? So the majority is sitting in this band here, which is between 3.25 and 3.5. It then notches up one band for 2023, that the majority expect the rate to sit between 3.5 and 3.75. And then by 2024 in that range as well. So we're pretty much on the same page. That if we look at the first step, I mean, looking into the future too far doesn't really help with the dot plots, but just looking at it, the immediate future here for 2022, we're expecting here between 3.5 and 4, looking at the futures, which I just showed you, and you can see we're sitting at about the same rate here, okay? And that tends to be the kind of rate that the Fed sees as neutral. Okay, they're up in their neutral rate to about 4%, which is they think they'll be neither accommodative nor restrictive at that point. Okay, so that's the price point they see for that. Okay, let's switch back to
that doesn't seem to square for me.
Randy, thank you very much. As always, you make a hard thing easy to understand. We appreciate it.
Randy.
Randy Krosner
Good people,
of the
Randy.
Booth School at Chicago.
He's like Tums. He makes it more digestible.
Yes.
The Fed chair's press.
Okay, stop waffling. So we've got 7 minutes now. 7 minutes before Jerome Powell comes up. So what we'll do is when Jerome Powell's speaking, we'll let him speak, and we'll just keep an eye on the charts as well at the same time, because that can tend to move the markets if he comes out hawkish. The key for us right now from a crypto perspective, need to keep Bitcoin above 20. If Bitcoin can navigate this kind of event above 20, that's a really good sign there for the 20 level to kind of hold, right? Now, it doesn't mean it will hold. We can still get orders below, and I've set a few limit orders to pick up some cheap Bitcoin below the 20,000 mark with a few ladders of limit orders. I suggest you guys do the same if you're looking to accumulate. Let's see if you guys have any questions in here. 164 of you guys. Let's smash up the like button, guys. Please do smash up the like button. Really does help this channel. The more likes we get, the more people. Kind of hard to hear your volume. Is that the mic volume or is that the TV volume? Let me know, guys, if you're struggling to hear. Yep, with we've already announced. Yep, 75 basis point increase in interest rates. Okay, 75 basis points. They've also revised their updates on summary of economic projections. They revised GDP down from 2.8 to 1.7, big revision down. They revised unemployment up from 3.5 to 3.7, and core inflation revised up from 1.9 to 3.4 for the rest of 2022. Okay, so not a great summary of economic projections, but more importantly, we got the rate hike that the market told Jerome Powell to give us. So you can see the market is really having to guide Jerome Powell into doing the right decisions here. So that's a good sign, I guess, that he's at least done it. MK, do you expect more volatility when Fed Jerome Powell comes out to speak? Yes. In fact, Jerome Powell can tend to have more of an impact than the volatility now, because most people, like you said, have priced in the rate hikes. So there's less volatility, but the stuff he says is the stuff that people aren't expecting. So that's important. Okay. Hey San, good to see you. Fapping, good to see you. Supernova Singh, good to see you. Brahm, Chili Money, Parabolic, Mikey, you guys are legends. Thank you for joining the live stream. Please do hit up the like button. If any of you guys want to trade any of the moves, check out the pinned comment to set yourself up on BYBIT and PRIMEXBT. BYBIT's offering up to $4,000. I use BYBIT to trade daily. I also use PRIMEXBT daily to trade as well. The good thing about PRIMEXBT is they're offering $7,000 in bonuses, and they give you you can do Forex on there as well. So a lot of people I know want to trade the dollar right now because remember, increasing interest rates is really good for the dollar. The dollar during a global recession tends to be the safe haven. Remember, not other countries don't have strong enough currencies and they rotate the dollar. Even though we may think dollars should be weak right now, it tends to do pretty well. Triple Money, good to see you. I like a live. Frosty Gaming. Gopesh, great feed. Keep up the work, dude. Appreciate you. Mick Valens, when an update on Fantom, we will let Jerome Powell speak. 3 minutes until Jerome Powell, so smash up the like button, guys. We'll sit here and listen to this press conference live to see what is the clue that we get. Gopesh says, when will Ijaz do a London crypto meetup? We should do one soon. Hamel Patel, great content. Keep it up. Mick Valens. Fantom, let's go. Happy. Okay, a lot of you guys want some Fantom updates. We shall give you guys Fantom updates. But the key right now is we need Bitcoin. We've seen a good green candlestick here by Bitcoin, trying to get above 20,700. We need a bit of breathing room here because we're still $800 or dollars away from 20,000, and Jerome Powell can easily swing that. So we got to be careful here. We don't want to lose 20,000. Whilst Jerome Powell is speaking. That would not be great whatsoever. Robert Powell, smash the like button, guys. Yeah, thanks, Robert. We do need everyone to smash up the like button so we can grow this channel together. We're getting up to close to 10,000 subscribers on this channel, guys. Now, when we do get 10,000 subscribers, I'm going to be giving away an iPad, but to people who are subscribed to this channel, and also you need to be deposited on BYBIT. Yes, I'm going to go through the list on BYBIT of everybody who's deposited at least $1. It just needs to be $1 so you can enter the raffle, and based on those people who have deposited, I will be sending them an iPad or cash equivalent if you guys want cash. Okay, so make sure you've done that, and you could be in for a chance to win. So please do get yourself set up. Also, for you guys, if you were signed up to BYBIT, we're going to do a whole bunch of things. We're going to do a whole bunch of airdrops, giving you guys allocations. We're going to do all kinds of things. We'll be doubling random accounts when we feel like it, based on how much you've deposited in the account. We'll be rewarding you guys. So do stay locked, stay subscribed to the channel. A lot more to come. Fapin B says, I'm buying Fantom throughout this bear market. Don't get too excited with altcoins. Right now, I'm focused on large blue caps. I'm focused primarily just on Bitcoin, Ethereum. These prices are so crazy right now. I mean, Ethereum sitting at $1,090 right now, really, really close to 1,000. I'm not waiting necessarily for it to go below 1,000. If it does, great. But even at these levels, I'm happy to be picking some up at those levels. Okay. That. And let's get ready for Jerome Powell, because Jerome Powell will be out any minute now, and we'll be covering that off with you. TV Powell will be coming on any minute now. I'm just getting it loaded up, and we'll listen to JP himself with his. He'll do a prepared statement. He always reads off a piece of paper, won't necessarily move the markets, and then after that, the Q&A is where the reporters, if they ask some good questions, we can get some interesting insights. So let's turn it back over to those.
Give you the kind of explicit guidance that President Mestre did, but he has to say something about the dashboard. What elements of the dashboard is most important to him? And he's got to say break even inflation.
Going to lapse into opinion here, but there seems to be a credibility issue. How do they restore it?
By sticking to this course of getting rid of inflation no matter what it takes. And no matter what it takes means allowing the unemployment rate to drift up and growth to slow down and even go negative. That's credibility.
And Bill, does he also need to explain their thinking? You know, a lot of Americans still think this is only because of oil and that has nothing to do with the Fed. Does he need to explain a little bit better why monetary policy needs to be in the driver's seat here?
All he needs is one sentence to say the mistake we made in the 70s was to go to wage price controls because we looked at individual markets. Right now, we need to
Guys, don't forget to smash up the like button. Just waiting on Jerome Powell. Recap for everybody who just joined this live stream. 75 basis points. This was really critical. I know it doesn't sound good because it means they're increasing interest rates, but the reality was we're in a really, really tricky situation. Anything less than 75, if we got 50, the market would have failed. Trust me, they're telling Jerome Powell we want more. Imagine you're in a market where they're asking for more interest rate hikes. If we had more than 75, if we saw 1 basis point, we would have failed. So this is pretty much the best case scenario. That being said, S&P is still red candle sticking down to the downside. Bitcoin sitting at 20,500. Don't also forget, please, that we covered off the summary of economic projections. You guys can rewind later to see that. But we're going to head on over now to Jerome Powell. You can see him just there behind me getting ready. Let's see what DGen Powell has to say.
Is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments.
We said 75 basis points.
Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food, and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Okay, so that's the end of his opening statement. So nothing too surprising there. We're seeing the S&P react nicely. We're seeing Bitcoin come above 21,000. Now over to the Q&A to see if anything shock comes out. There's nothing surprising by 0.75. It's the key, is the most beneficial thing we could do, which is going to give us sideways to upward. It's just how much up can we go, or is it just going to be
as
sideways?
detailed a sense you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations.
Nice. Moving nicely here on the S&P. If we can keep it up, Bitcoin
and we thought
can keep
for
running
a while, we thought, well, this is the
21,
appropriate thing to do.
800-ish on
So then the
Bitcoin.
question is, what do you do?
You smash
And
the
do
like
you
button,
wait
guys.
6
Smash the like
weeks
button.
to
200
do it
of you
at
in
the
here.
next meeting?
Smash
And
up
I
the
think
like
the
button.
answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Okay, Gina?
Thanks for taking our questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, you know, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year, and that's 6 months from now. And you know, so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are, and that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. So, and if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening in a range of maybe 3.5 to 4%, and that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year. Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5 to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect
getting a decent move on the S&P here, but again, don't fall for it too much, guys. We need to let the dust settle. Don't go crazy YOLOing. If you're scalping or day trading or BYBIT, fine. If you know what you're doing, do that. But anybody looking to purchase long term, just hold fire for now. It's not going anywhere anytime soon. That you're not going to catch it.
Real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate. That affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand, and that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I would think about it.
A nice wick for Bitcoin above 22,000, but now it's just starting to red candlestick. But at least we got some breathing room now.
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that
we've had up to 1,000 people watching this live stream, guys, which is great for this channel. So those of you who are new here, please do smash up the like button. Make sure you subscribe. We're just loads of good content on this channel. Make sure you keep up with us 2 to 3 times daily updates on crypto. Make sure you get involved.
As you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised. Nonetheless, it was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data, and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where
so far so good. Powell hasn't tripped up just
as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance, and so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy.
Just listening live, guys, I'm getting the impression Powell is still being too softy, right? When he said 75 basis point is large, I don't expect this to be too common. A bit too softy for me. The markets need a good slap. He needs to give some, because they're not taking him seriously. You know, like a parent when the kid's not taking a kid seriously, he needs to put his foot down.
We're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause, even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point, and we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late during blackout, very close to our meeting. Very unusual, to one that would actually change the outcome. So I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, 1 or 2 times. So I don't think it's something that'll come up a great deal.
Colby.
just covering up like why he's doing it. Just come out and say you're doing 75 basis points.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
So the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down. So, but and right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, that you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done, because we saw, and frankly, we saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation of our policy is going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take for example in the labor market. So you have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed,
Bitcoin
but you
back
could
in
see
the red for the
prices
day,
coming
down
down
2.6%. Not as bad as it was earlier, but also not as high as when we just quickly spiked to 22.
Suggest because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So you're right. In the SEP, we have unemployment going up to 4 point. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where, where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place, but to get there, it's not going to happen with the levels of inflation we have. So we have to restore that, and it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate in the SEPs over the next couple years, and it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though, so I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
Not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in, prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for, such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world. I mean, lots of countries are looking at inflation of 10%, and it's largely due to commodities prices. But all over the world, you're seeing these effects, and and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really. And by the way, headline inflation is important for expectations. The public's expectations. Why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're, of course, watching very, very carefully for that, and looking at the retail sale, the big store numbers and all that kind of thing. And so, but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall, spending is very strong. The consumer is in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown.
Nice. Looks like we're going to try have another push here on the S&P.
Levels. We see the economy slowing a bit, but still,
guys, if you haven't hit up the like button, smash up the like button. It's the only way I know if you like these live streams, we can do more of them. So do that. So when I look at the stats on the analytics later on, I can see you guys responded well to the live stream.
Another indicator that you're watching more closely.
It would be hard to watch anything much more closely than we watch consumer spending, but we watch everything. We watch business fixed investment, which actually has softened a bit. We're responsible for watching everything, but consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately, it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Thank you, Mr. Chairman. Michael McKee from Bloomberg Radio and Television. Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. We, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't.
Just want to remind you guys, we don't want to get too excited just now. Okay, we got to remember where we're at on Bitcoin until we at least get to 24,000. That's a key level of support we need to reclaim before we can mount an attack back to the channel which we're in, which starts at 28,000, right? So a lot of work to do here. We're still precariously close to 20,000, but remember, this is the best case scenario we could have had. So good to see that we're slightly above 20,000. We've got 1,500 of breathing room now, but there's a lot to go, right? There's still a lot to go.
The elements that make up headline that are not in core.
Could I just, as a follow-up, get a clarification on the SEP? When the members gave their forecasts? When were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point move?
The SEP is of one piece. It reflects all of the economic readings. It also reflects the 75 basis point increase. This is important. So people had that in hand when their SEPs were submitted. So in other words, it's not in addition to what's in the SEP. The SEP, everyone's SEP reflects their thinking about this rate increase and what's going forward.
That's good. That's important.
Hi, Victoria Guida from Politico. I wanted to ask about how you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to see inflation coming down over a series of reports, and I guess I'm curious whether you think inflation data itself is a really good indicator, or whether you might be concerned that it's a lagging indicator, or that it might send confusing signals, given that, as you've talked about, there are sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
So I think the role that we can play, maybe the way to get at it is to say that the role that we can play is around demand, right? So, and we'll be able to see the areas that we can affect are those that are associated with excess demand. And we'll be able to see our effect on, for example, job openings in real time. So, and that would tell us about wages. Wages are not principally responsible for the inflation that we're seeing, but going forward, they would be very important, particularly in the service sector. So, sorry, I'm not sure I'm getting to your question.
My question is inflation data itself the best indicator for when you're getting to where you need to go, or might it lead you to go too far?
There's always a risk of going too far or going not far enough. And it's going to be a very difficult judgment to make, or maybe not. Maybe it'll be really clear. But we're quite mindful of the dangers. But I will say the worst mistake we could make would be to fail. It's not an option. We have to restore price stability. We really do, because everything, it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work the way it's supposed to. It won't work for people. Their wages will be being eaten up. So we want to get the job done. This inflation happened relatively
By the way, very interesting today that Bitcoin dominance has gone down 1%. You can see all coins are holding gains, right? Fantom up 4%. Fantom's up 6% versus Bitcoin today. So pretty insane. You've got Avalanche up 2%, 6% on Cardano. Very, very interesting.
Is very likely to be successful in getting inflation down to 2%, and that's critical. It's absolutely key to the whole thing that we sustain that confidence. So that's how we're thinking about it.
Hi, Brian Chung with Yahoo Finance. I just want to expand, I guess, on what you just said now about the general public feeling like, you can get this done. When you talk about consumer sentiment being down, household inflation expectations being up, recession just broadly being dinner table talk, does the general feel among American households and also businesses square with your explanation of the economy, given that the description of inflation in the statement didn't change between May and June? Thanks.
So clearly, people don't like inflation a lot, and many people are experiencing it really for the first time, because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways, and we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. Clearly it's an incredibly unpopular thing, and it's very painful for people. So, but I guess what I'm saying is the really critical question from the perspective of doing our job is making sure that the public does have confidence that we have the tools and will use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down, but we will do that.
Chris.
Thank you. Chris Rugaber at Associated Press. You have talked about inflation a few times and mentioned oil prices, China lockdowns. But aside from rises in commodity prices such as gas prices, we're also seeing stickier measures of inflation increasing, such as the Cleveland Fed's median and trimmed mean CPIs. I mean, how persistent do you see those underlying measures of inflation, and how do you expect to, and where do you see those going in the near future?
Yeah. So, as I mentioned, I think in my opening statement, the inflation has started off in quite narrow, very directly pandemic-related areas, and it's spread now broadly across the economy and into the services sector as well. It was really in the goods sector at the beginning. And in particular, you're seeing in travel now, if you've flown on a plane lately, planes are very full and plane tickets are very expensive. Some of that will be passed through of energy prices, but it's you're experiencing services inflation. Shelter inflation is high. So so the question, and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing progress, and we want to see progress, and that's really another part of why we did what we did today, and why the SEP looks like it does, is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Do you still think a softish landing is possible, and how would you define that at this point, considering the revised projections for unemployment, GDP, inflation?
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. That would be, I would call that as meeting that test. Do I still think that we can do that? I do. I think there's. I don't want to be the handicapper here. That is our objective. And I do think it's possible. Like I said, though, I think that events of the last few months have raised the degree of difficulty, created great challenges. And again, the answer to the question, can we still do it? There's a much bigger chance now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices could wind up taking that option out of our hands. So we just don't know. But we're focused on, very, very focused on getting inflation back.
Not a great answer, right? He started it off okay. He said the SEP gives us a clear guide plan and a soft landing, but then he started saying, oh, it's out of our control.
To a sustainably strong labor market like the one we had before the pandemic.
Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that now there's even more risk of a recession than a 50-50 path of rates. So could you talk a little bit more about that, and what evidence would get you to stop rate hikes and maybe even reverse them?
Sure. So
significant reduction.
As I mentioned, financial conditions have tightened over the last 7 months, and that's a good thing, we think. But the federal funds rate, even after this increase, is at 1.6%. So it's hard to see how that is too high of a rate. And even if we did another, we're going to get here by the end of the summer somewhere in the twos probably. Still, that's still a low rate. So that's not a rate that is calculated to bring a recession on. And by then we'll have seen a whole lot more data. As I mentioned a couple times, the committee's views are around a modestly restrictive stance, which would be in the 3 to 3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today. We'll be watching if things go in a direction we don't expect, then we're going to adapt. And I would say this is a highly uncertain environment, extraordinarily uncertain environment. So again, we'll be determined and resolved, but flexible.
Okay, Evan.
Evan Reiser, Market News International. Thank you, Chair Powell. I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public? And then secondly, given the illiquidity and extraordinary volatility in financial markets, are you concerned that QT will make that worse?
Sorry, what was your question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse.
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent. It's hard to overstate the extent of interest we have in that question, morning, noon, and night. So, but you have to understand the context. Really the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. It is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So we have now experienced an extraordinary series of shocks, if you think about it. The pandemic, the response, the reopening, inflation, followed by the war in Ukraine, followed by shutdowns in China. The war in Ukraine potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it. And we've done a lot of work internally on and thinking about what all that means. The thing is, you don't know whether those forces are, what extent are they going to be sustained? In other words, will we go back to a world that looks a little more like the old world, or are we really going to be in a world where major supply shocks go on and on? The history is you see these waves of supply shocks, as you did in the 70s, and then they go away, and sort of there's a new normal and things settle down. But honestly, we don't know what that's going to be. In the meantime, we have to find price stability in this new world and maximum employment in this new world where clearly inflationary forces you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely extraordinary. It's not just here. In fact, we're sort of in the middle of the pack, although I think we have, of course, a different kind of inflation than other people have. And
getting another pump there on the S&P. Bitcoin trying to follow. Bitcoin holding up pretty nicely here at 21,800. Powell's not said anything too horrible just yet, but again, wasn't expecting a big move up, so it's just better that we're not in the red. I think that's probably the positive to take away from this meeting.
Markets seem to be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been. So I have no reason to think markets are forward-looking and they see this coming. I have no reason to think it will lead to illiquidity and problems. It seems to be kind of understood and accepted at this point.
Thanks. For the last question, we'll go to Mark.
Last question.
Mr. Chairman, Mark Hamrick with Bankrate. Wonder what your assessment is about the outlook for the housing market given the years-long increase in home prices and now the sharp rise in mortgage rates. And all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis over a decade ago. Thank you.
Sure. So rates were very low. A good place to start is that rates were very, very low for quite a while because of the pandemic and the need to do everything we could to support the economy when unemployment was 14% and the true unemployment rate was well higher than that. So, and that that was rates are low, and now they're coming back up to more normal or above levels. So in the meantime, while rates were low and while demand was really high, obviously demand for housing changed from wanting to live in urban areas to some extent to living in single-family homes in the suburbs, famously, and so the demand was just suddenly much higher and low. So we saw prices moving up very, very strongly for the last couple of years. So that changes now, and rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. It's, obviously we're watching.
Bitcoin go for another test at 22,000. That'd be a great level to get past.
So there's a tremendous amount of supply in the housing market of unfinished homes, and as those come online, whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. So it's a complicated situation. We watch it very carefully. I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we ideally do our work in a way where the housing market settles in a new place and housing availability and credit availability are at appropriate levels. So thank you very much.
All right, so there you have it, guys. That was the FOMC meeting and press conference by Jerome Powell. Thank you for joining me on this one. What I'll do now is I will do a 10 to 12 minute summary video for those of you who weren't able to catch all of that. But in essence, 75 basis point rate hike. We saw what happened there. We saw the revisions in the summary of economic projections, revising GDP, revising core inflation and the unemployment rate. And Jerome Powell finally came out and did what he had to do, but he was told by the market to do it. Now, just switching over here, let's show you what we've got here on the charts before we go. And you can see now the S&P trying to, now that Jerome Powell's finished talking, there's no risk of him saying anything dangerous. He's going to try and have a little bit of rally, but please be careful. I'm going to mention in my summary video what I think will go from here. But overall, for me, I think that is the best case scenario for today. But now what's going to happen over the next few weeks and months, that's going to be the question on every investor's mind. Thanks for joining me on this live stream, guys. If you haven't already, please do smash up the like button on your way out. Really does help a channel like this get more exposure to other potential viewers. Smash up the like button and subscribe. Make sure you hit up the subscribe button. That's the most important one. And I'll see you in the next one.